A warehouse sounds like the simplest investment in commercial real estate. You buy a big steel box, you find a tenant who needs to store or ship things, you sign a long lease, and you collect rent while they do all the actual work. No glamorous tenants to manage, no foot traffic to worry about, no fickle consumer taste to chase. Just concrete, steel, and a check that shows up every month. In the era of same-day delivery, it looks like the closest thing real estate has to a sure bet, the physical backbone of an economy that increasingly runs on boxes moving from shelves to doorsteps. That description isn't wrong. It's just incomplete in a way that has cost some very sophisticated investors a great deal of money. Between 2021 and 2023, the value of warehouse properties in some of the busiest logistics markets in the country fell by double-digit percentages, in some cases more than a quarter of their value, while the rent those same buildings were collecting kept climbing. The buildings were full, the tenants were paying, and the owners were still watching their equity shrink. That combination shouldn't be possible if a warehouse is really just a box that generates rent. So the question worth answering is this: what is a warehouse actually worth money for if it isn't simply the rent it produces?
The answer starts with a shift in how you have to think about the building itself. A warehouse, physically, is one of the cheapest and least differentiated structures in real estate. It's a concrete slab, tilt-up walls, a steel roof frame, and a lot of empty air inside. Any competent contractor can build one in well under a year. There's no architectural signature, no scarcity of materials, nothing that makes one warehouse structurally special compared to another built the same way 3 states over. If the building itself were the source of value, warehouses would be a commodity business with thin, boring margins, which, in a sense, construction of them is. But owning one isn't a construction business. It's a bet on 3 things layered on top of that cheap structure: where the land sits, who signs the lease, and what interest rates do over the life of that lease. Start with the lease because it explains why warehouse ownership looks deceptively passive. Most warehouse tenants sign what's called a triple net lease, often shortened to NNN. Under the structure, the tenant, not the landlord, pays the property taxes, the insurance, and the maintenance costs on top of the base rent. That's a meaningfully different deal than owning an apartment building or a shopping mall, where the landlord absorbs a lot of operating risk and unpredictable expense. With an NNN warehouse lease, the landlord's cash flow is close to guaranteed, on paper, for as long as the tenant is solvent and the lease is in force. That's part of why warehouses got marketed to investors as bond-like, steady, predictable, low-drama income.
But calling something bond-like is a bigger admission than it sounds like, because bonds are extremely sensitive to one thing: interest rates. And that sensitivity is exactly where the story stops being simple. Before getting to rates, though, there's a second layer worth understanding, because it explains why location does almost all the real work in warehouse value. Since the building itself is cheap and replicable, what actually makes one warehouse worth far more than another isn't the structure, it's the dirt underneath it. Land close to a major port, a rail hub, or the outskirts of a dense metro area is finite in a way concrete and steel are not. You can always pour another slab. You cannot manufacture more land 20 minutes from the Port of Los Angeles or the interchange of 2 interstate highways. That scarcity is what allows rents in prime logistics corridors to run several times higher than rents on warehouse sitting an extra 90 minutes away from the same population center, even when the buildings themselves are nearly identical. The box is a commodity. The location is not. This is also where a second, less obvious form of value or risk shows up: the building's specifications. Modern logistics tenants, particularly the ones running high-volume e-commerce fulfillment, have gotten extremely specific about what they need physically. They want clear ceiling heights of 36 to 40 feet so they can stack inventory or install automated racking systems. They want dozens of loading dock doors along the building's length so trucks can load and unload simultaneously. They want deep concrete truck courts so trailers can maneuver and park without a logjam. A warehouse built in the 1990s with 24-foot ceilings and a handful of dock doors might be perfectly sound structurally. The roof doesn't leak, the walls are solid, and still be functionally obsolete for a major logistics tenant. It simply can't do the job modern operations need, no matter how cheap the rent is. That's a strange kind of decay, a building that fails economically while remaining physically fine. It's a quiet reminder that in this business, still standing and still valuable are not the same claim.
Now bring in interest rates, because this is where the apparent safety of a warehouse turns out to be conditional rather than permanent. When an investor buys a warehouse, the price they're willing to pay is closely tied to something called the cap rate, short for capitalization rate. In simple terms, the cap rate is the annual rental income divided by the property's price, expressed as a percentage. A warehouse producing $1 million a year in net rent, priced at a 5% cap rate, is worth about $20 million. Push that same building's cap rate up to 6% with the same $1 million of rent, and its value drops to roughly $16.5 million, a loss of more than $3 million without the rent changing by a single cent. Cap rates move for a lot of reasons, but the biggest one is the cost of borrowing money. When interest rates are low, investors can borrow cheaply to buy real estate. Competition for buildings increases, and buyers are willing to accept a lower cap rate, meaning they pay more for the same stream of income because the alternative, parking money in bonds or savings accounts, pays them almost nothing. When interest rates rise sharply, that calculus flips. Borrowing gets more expensive, safer assets like government bonds suddenly offer a real return, and buyers demand a higher cap rate to make real estate worth the risk. The rent hasn't changed, the building hasn't changed, but the price someone will pay for that same rent check has fallen, sometimes substantially, purely because the alternative uses of money got more attractive.
This is the mechanism behind that seemingly contradictory pattern from a few minutes ago: rising rent, falling value. It happened at real scale starting in 2022, and the setup for it had actually been built 2 years earlier during the pandemic-driven e-commerce surge. In 2020 and 2021, online shopping accelerated at a pace that would normally have taken years to reach, compressed into months. Retailers and logistics companies scrambled for warehouse space near major population centers to support faster delivery promises. Vacancy in the best logistics markets fell close to zero. Rents climbed sharply. And because interest rates were near historic lows through this same period, cap rates compressed at the same time. Investors were willing to pay more for warehouse income than they ever had before, betting that the e-commerce boom was structural, not temporary. Large institutional players, including major industrial real estate investment trusts like Prologis, one of the largest warehouse landlords in the world, and private equity firms such as Blackstone, moved aggressively to buy up logistics real estate during this window. Developers responded to the demand and the cheap capital the same way builders always do when a market looks unstoppable. They started building speculatively. That means constructing warehouses without a signed tenant in hand, betting that demand would keep absorbing new supply as fast as it arrived, often financed with short-term or floating-rate construction debt on the assumption that rates would stay low and refinancing would be easy.
That assumption held for about a year and a half. Then, it didn't. Starting in 2022, central banks, most consequentially the U.S. Federal Reserve, raised interest rates at one of the fastest paces in decades to fight inflation. The effect on warehouse values arrived almost immediately, well before it showed up in occupancy or rent numbers. Because valuation moves on expectations about future cash flow and the cost of money, not just current income. Cap rates across industrial real estate expanded, often by a full percentage point or more in the span of a year, which, using the same math from before, meant meaningful drops in property value even for buildings with rising rent rolls. Owners who had financed acquisitions or new construction with short-term debt now faced refinancing at rates 2 or 3 times higher than what they'd originally borrowed at, on properties that were simultaneously worth less on paper than when they bought them. Some of those owners had no choice but to sell at a loss or hand properties back to lenders simply to escape debt they could no longer service.
That's the first domino. The second is more specific to warehouses than to real estate generally, and it goes back to the speculative building spree from 2021. A huge amount of new spec warehouse space, greenlit during the boom, kept getting delivered through 2022 and into 2023 and 2024. Construction timelines don't reverse quickly just because conditions changed. That new supply arrived right as e-commerce growth normalized from its pandemic spike back toward its long-term trend, and as some large tenants who had overexpanded during the boom began giving back excess space rather than absorbing more. The result, in several of the country's biggest logistics markets, was rising vacancy for the first time in years, not because demand collapsed, but because supply had been built for a growth rate that didn't sustain itself, layered on top of a much higher cost of capital.
The Inland Empire region of Southern California is one of the clearest real-world examples of this whole cycle playing out, because it's the single largest warehouse and logistics market in the United States, sitting inland from the ports of Los Angeles and Long Beach, which together handle a substantial share of all containerized imports into the country. During the pandemic boom, vacancy in the Inland Empire reportedly fell to close to zero, and asking rents roughly doubled in a few years, according to commercial real estate research firms that track the market. Institutional capital poured in, competing hard for both existing buildings and speculative new construction. Then, as interest rates rose and a wave of new spec supply hit the market at once, vacancy in the region climbed to its highest level in over a decade by 2023 and 2024, even as the market remained, by any historical standard, one of the tightest and most valuable industrial regions in the country. Owners of well-located, well-leased modern buildings with strong tenants largely weathered the shift. Their income kept flowing, even if paper valuations softened. Owners of newer speculative buildings, financed with aggressive short-term leverage and still searching for a tenant when rates spiked, were the ones who took the hardest hit. Same asset class, same region, dramatically different outcomes, depending entirely on the layers underneath the building itself, the lease, the leverage, and the timing of the debt.
The industry adapted the way industries generally do after getting burned by the same mistake at scale. Developers pulled back sharply on speculative construction and shifted toward build-to-suit projects, buildings only broken ground on once a tenant has already signed a lease, removing the gamble on future demand. Lenders tightened terms and pushed borrowers toward longer-term fixed-rate financing instead of the short-term floating debt that had turned a valuation dip into a forced sale for so many owners. There was also a quieter shift in what kind of warehouse got built at all, away from the enormous million-square-foot boxes built for peak boom absorption and towards smaller last-mile facilities closer to dense population centers, designed for the final, most time-sensitive leg of delivery rather than bulk storage. And across the industry, buyers began paying much closer attention to weighted average lease term, how many years, on average, a building's leases have left, because a long lease with a financially strong tenant is now understood as real protection against exactly the kind of value swing that hit the market starting in 2022, while a short lease or a vacant spec building offers none.
Put the best and worst versions of warehouse ownership side by side, and the difference isn't really about whether e-commerce keeps growing. Most forecasts still expect it to, over the long run. The difference is about what's underneath the rent check. In the best case, an owner holds a modern, well-specified building in a supply-constraint location, leased for a decade or more to a financially sound tenant, financed conservatively with fixed-rate debt. That owner rides out interest rate cycles largely unbothered because the income is durable and the debt doesn't need refinancing at the worst possible moment. In the realistic middling case, an owner holds a solid but shorter leased property in a market that saw meaningful new supply. They don't lose the building, but they watch its paper value bounce with interest rates and occasionally have to fight harder to release at a competitive rate when a tenant leaves. In the failure case, an owner holds a speculative, recently built warehouse in an oversupplied submarket, financed with short-term debt, still hunting for its first tenant when rates spike, and that owner can lose the property entirely, not because the fundamental idea of warehouse investing was flawed, but because every layer of risk stacked in the same direction at once.
So, return to the assumption sitting underneath the opening picture, the steel box, the reliable tenant, the passive check every month. That picture isn't false. It's just a surface of something with several more moving parts underneath it, most of which have very little to do with the building itself. A warehouse is really a bundle, a lease contract, a piece of scarce land, a set of physical specifications that can go obsolete without a single wall crumbling, and, perhaps most importantly, an implicit bet on where interest rates are headed, because that's what ultimately decides what the income stream is worth to the next buyer. The rent is the part investors see and understand. The interest rate exposure is the part that decides whether that rent ever gets to matter. That's what a warehouse actually is underneath the surface. Not a rent machine, but a leveraged position on land scarcity and the cost of money, wearing the disguise of the most boring, dependable asset in real estate.